A topic that's on everyone's mind: recession survival. And who better to guide us through these choppy economic waters than the financial guru himself, Peter Schiff? In today's video, we're revealing Peter Schiff's top picks for assets to buy to not just survive, but thrive in the 2024 recession. If you're wondering where to put your money to keep it safe and growing, stick around. Peter Schiff, a prominent figure in the investment world, is known for his bold predictions and outspoken views on the economy. He gained widespread recognition after accurately predicting the 2008 financial crisis and has since become a vocal critic of the Federal Reserve's monetary policies. Schiff consistently warns of an impending financial downturn, urging investors to maintain a long-term focus and protect the gains they've made in recent years. Schiff's predictions may spark debate, but they're grounded in solid economic principles. Through his popular podcast, The Peter Schiff Show, he has built a large following by challenging conventional wisdom and encouraging independent thinking. While his forecasts might not always come true, they offer valuable insights that prompt serious consideration among investors. Schiff paints a rather bleak picture of the future for the US economy. While some may dismiss his persistent warnings as overly pessimistic, it's hard to ignore the valid concerns he raises. The US national debt has been steadily climbing for decades, now surpassing $30 trillion. This massive debt load raises questions about the government's ability to repay it without resorting to drastic measures like inflation or higher taxes. In addition to the growing debt, the anticipated rise in the cost of social welfare programs could further strain the federal budget in the coming years. Some argue that the current tax code discourages investment and economic growth, making it even harder for the economy to overcome these debt-related challenges. These issues are why Schiff famously warned, when the dollar finally falls, it's going to implode. It's just going to collapse overnight. Interest rates are going to spike up, and you're going to see a bond market crash. Whether or not Schiff's predictions come true, he remains a significant voice in the financial world, offering perspectives that help investors understand the complex forces shaping the global economy. Schiff argues that a recession could trigger higher inflation, driven by factors like reduced production, supply chain disruptions, and government stimulus efforts. A weakened dollar can worsen inflation by making imports more expensive, leading to higher prices for a wide range of goods and services. This inflationary pressure can erode the value of fixed-income investments, such as bonds, and make stocks less attractive due to the diminished outlook for future earnings. Schiff's emphasis on the dangers of inflation during a financial crisis is well-founded. He advises investors to be cautious about putting their money into assets like stocks and bonds that are particularly vulnerable to inflation. His warning highlights the importance of considering inflation risks when making investment decisions, especially during uncertain economic times. One of Schiff's key recommendations is to steer clear of US stocks and bonds, particularly given the risks associated with high levels of government and corporate debt. He argues that the US market's immense debt burden is unsustainable and that rising interest rates could make it difficult to service this debt. This in turn could lead to defaults and trigger a significant financial crisis. Schiff's caution against investing in US stocks and bonds stems from his belief that the current levels of debt pose a serious threat to financial stability. By urging investors to divest from these markets, he urges and highlights the potential risks that could arise from a debt-laden economy facing rising interest rates and inflation. Peter Schiff remains a compelling figure in the world of finance, offering insights that encourage investors to think critically about the economic landscape. While his predictions may not always hit the mark, his focus on long-term stability, the dangers of inflation, and the risks associated with debt-laden markets provide valuable guidance for those looking to navigate the complexities of investing in uncertain times. Peter Schiff believes that the next major financial crisis won't stem from the subprime mortgage market like in 2008, but from the bond market. He warns that a collapse in bond prices could trigger widespread economic turmoil. With debt levels soaring and signs of instability on the horizon, Schiff sees limited opportunities for substantial returns in both stocks and bonds, making these assets increasingly risky to hold. Given these concerns, Schiff advises investors to focus on companies in Europe and Asia that are known for paying reliable dividends. Dividends can provide a steady income stream even if share prices fall, offering a buffer during tough economic times. Additionally, investing in stocks that are denominated in currencies other than the US dollar can protect against the potential depreciation of the dollar, which could otherwise erode the value of US-based investments. European and Asian markets also seem more attractively valued compared to the US, presenting what Schiff views as better opportunities for long-term returns. By investing in dividend-paying stocks outside the US, investors can mitigate some of the risks associated with the domestic market. This strategy aligns with Schiff's broader investment philosophy of looking beyond the obvious and finding value in overlooked areas. Schiff emphasizes that regardless of current market trends or popular sectors, investors should always conduct a thorough evaluation of a company's fundamentals and intrinsic value. Key metrics like the price-to-earnings ratio are essential for determining whether a stock is overvalued. Even stocks within hot sectors can be unsustainable if their prices are detached from the company's underlying fundamentals, making them vulnerable to sharp corrections. In many sectors today, stock prices have surged to levels that are difficult to justify based on the company's financial health and performance. According to Schiff, this has created a bubble that is likely to burst, which fits with his generally pessimistic outlook on the US economy. His focus on valuation serves as a warning against chasing after overhyped sectors without paying attention to the fundamental weaknesses that might be lurking beneath the surface. Schiff's perspective also adds an interesting angle to the ongoing debate between active and passive investing. He suggests that in times of economic shifts or potential collapse, active management becomes crucial. Active investors can adapt to market fluctuations and identify undervalued sectors, while passive investors, who simply hold onto their investments regardless of market conditions, may find themselves facing significant losses. Schiff's outlook on the bond market is particularly concerning. Bonds have traditionally been seen as safer investments, providing steady income with lower risk compared to stocks. However, Schiff warns that this perception could be dangerously outdated. As internet rates rise, bond prices could fall dramatically, leading to losses for investors who thought they were playing it safe. This potential collapse in the bond market could have ripple effects throughout the economy, affecting everything from corporate financing to government debt. Schiff's advice to steer clear of US stocks and bonds is rooted in his belief that the levels of debt within the US market are unsustainable. He argues that as interest rates increase, the cost of servicing this debt will become more burdensome, leading to defaults and potentially triggering a significant financial crisis. By looking to international markets, particularly in Europe and Asia, investors can diversify their portfolios and reduce their exposure to the risks associated with the US economy. In addition to focusing on dividend-yielding stocks in foreign markets, Schiff advocates for a cautious approach to investing overall. He warns against getting caught up in the excitement of rising markets or popular sectors without fully understanding the risks involved. His emphasis on valuation and fundamentals is a reminder that successful investing isn't about following the crowd, it's about making informed decisions based on a deep understanding of the market and the underlying health of the companies in which you invest. What is your opinion regarding this video? Let us know in the comment section below, and don't forget to like, share, and subscribe to our channel.